In this lecture, we're going to continue on with the basic concepts of managerial accounting that we're going to use throughout this course. As you recall, last lecture we talked about the cost object. And just to refresh our memory, that means any aspect of a business that the manager wants to know the cost. And a manager can divide up a business in many different ways, by geographic region, by the product, by the functions of the business. One of the most common is the product cost, right? So businesses that make different products often want to know how much each of those products cost. So this is a very, very common tool that managers use and are likely to use. So let's start out by just kind of getting an understanding of this. We want to take all the cost, all 100% of the cost of the organization. We want to divide it up, and we want to put it into either cost for the product, or we want to put it as what they call a period cost. The period costs are not related to the product directly, but to the period of time. And so we'll see what that means in a second. So as you recall, there are three types of organizations. There's the service, the merchandising, and the manufacturing business. So if you're a service business, then you're not going to have any product cost. So if you're a service business, there are no product costs. All costs end up being period costs. So for example, your marketing, your customer service, your payroll, electricity, anything, they're all considered period costs. Now what about the merchandising? So what about the merchandising costs? How are we going to divide those up between the product cost and the period cost? So remember, with the merchandising company, we are selling products that are already made. So when we look at a merchandising company, we're focusing the products or the cost of the products that, the product costs are going to be the cost of the inventory that we get from whoever manufactured it. So the cost of the inventory, right? So the inventory cost, and then any cost to get that inventory to us. So and ready for sale to the customer. So freight, which is a fancy word for shipping, right? Freight costs, and any other costs that we have to pay, like if we have to pay customs or duties or tariffs. Those would all be costs that we need to do in order to get the merchandise inventory on the shelf. So that leaves the rest of the cost to be period costs. So for example, marketing, customer service, accounts receivable, people that owe us money, right, or businesses that owe us money. Those would all be examples of period costs. So these are not directly associated with the inventory costs, which are what we would consider product costs for a merchandising type organization. So what about the manufacturing business, right? So with a manufacturing business, it's going to be a little bit more complicated because we're converting raw material into the finished good. Okay, so when we look at the manufacturing business, what we want to do is we want to look at three areas and that are associated with building the product in our factory. Now, one thing that you want to keep in mind, might put this in your notes, is to know the product cost in manufacturing is to focus on what happens in the factory. It has to be in the factory for it to be a product cost for manufacturing. Okay, it has to be in the factory for any of these costs. So we have three types. We have direct material, we have direct labor, and we have manufacturing overhead. So those are the three costs that we're going to be using throughout this course. So it's very important that we get a grasp of these. So those three costs are extremely important. Direct material, so you need to know the definition of this. This is the primary material that's used in manufacturing our product. So if we were manufacturing cars for Ford, it would be the steel, the rubber, the plastic that goes into the car itself, right? Primary material. These are physically part of the car. Physically part of the car. So you know it's a direct material because you can go up and you can touch it. Are tires a direct material? Well, you can go up to the product and you can put your hand on the tire. So obviously it is. And then you have your direct labor. So direct labor are the people in the factory who are directly building the car. I call them like the hands-on people on the assembly line because they're the ones putting the steering wheel on the car. They're the ones installing the radio in the car. Now there's other people in the factory, but those are not direct labor. So there's somebody who's working there to fix the machinery. That's not direct labor. If there's somebody who's in charge, the supervisor of the place, that's not direct labor. You see, inside the factory, and so remember, this always has to be inside the factory, there's other things going on, and the rest of the stuff that goes on in the factory is manufacturing overhead. So let's look at a couple. First of all, we have the indirect material. So what if we need some like oils or lubricants for the machinery? That does not end up in the car, it's used for the machinery, so that's indirect material. Or what if we need some cleaning solvent, to clean the floors of the factory? That's indirect material. It's a manufacturing overhead because it's in the factory. We have the same thing that's going on for indirect labor. You have a person who's in charge of, fixing the machinery that breaks. That's indirect labor because that person's not actually putting the cars together. So anybody in the factory, and if you want to get these right, you just have to think of this as in the factory. Product costs are in the factory. So anything that goes on in the factory is going to be a product cost. If it's not direct material and it's not direct labor, then that product cost has to be manufacturing overhead. So let's see another one that some other indirect cost associated with manufacturing in the factory. We could have the insurance on the factory. Now be careful here because if you have insurance on the sales office, that's a period cost because it's not in the factory. Remember, think in the factory. What about property tax on the factory? That would be an indirect cost associated with manufacturing. That would be overhead. But property tax on the home office, that would be a period cost because it's not in the factory. So all this stuff you could think of as being in the factory. All this stuff is anything else that goes on with the business, with the factory that's not in the factory. Right? Let's move down a few inches here and give us some more room. Let's see. Depreciation on equipment. That's definitely going to be manufacturing overhead. It's in the factory. But depreciation on the office equipment, that would not be. Utilities in the factory, that would be a manufacturing overhead, but utilities at the headquarters, that would be something else, right? We're assuming that the factory is not the same as the headquarters or the home office, just to make it simpler. Now, also remember that there's other things that could be period costs. Anything that's not in the factory but is a cost is a period cost. So if it's not in the factory, like a delivery van, that would be, an example of a period cost. Or shipping, right? That would be an example of a period cost. Or marketing. None of these things go on in the factory, so that means that they're period costs. I don't know. I think you get the idea. So that's what we're talking about when we're talking about product and period cost. If we go to the chapter, you'll find the summary problem in this chapter. And let's just look at this, part 2. For a manufacturing company to identify these as either product cost or period cost. So I want you to answer these in your head as we work along. And if you're not getting them right, then you need to look into it. All right, so first of all, depreciation. Well, that doesn't tell us enough. Depreciation on equipment, that doesn't tell us enough. We have to know whether it's in the factory, and of course plant means factory, so or not in the factory. Since it's in the factory, it's on the plant equipment, that means it's definitely a product cost. Okay? Now, is this direct material, direct labor, or manufacturing overhead? Well, it's not direct material and it's not direct labor, it's depreciation. Remember, depreciation is just taking the cost of the equipment. Let's say the equipment cost us $100,000 and dividing it over the useful life of the equipment. So if we use the equipment for 10 years, then 100,000 divided by 10 is 10,000. So that means the depreciation on the plant equipment would be, for example, $10,000 a year. Okay, so that's going to be a manufacturing overhead cost because it's in the plant, it's in the factory, and it's not direct material or direct labor. Depreciation on the salespeople's automobile, well, that's definitely going to be outside of the factory. So that's going to be a period cost. That's not a product cost. And then insurance on a plant building, on the factory. Think about it. Is it in the factory? Yes. So it's going to be a product cost. Is it direct material or direct labor? No. So that's going to be manufacturing overhead. So what about D, marketing manager salary? What do you want for that? That should be period cost. Cost of the major components of the finished product. That means the pieces that go into our product. So if we're talking about the Ford automobile, that would be like I don't know, the seats, a major component of the finished product. Seats are direct material. Direct material is a product cost. That's in the factory. Assembly line worker salary. So assembly line workers are hands-on. They're in the factory. Product cost, direct labor. Cost of shipping the product. Shipping is outside the factory. Shipping outside the factory. It's a period cost. The plant lift operator salary. It's in the factory. Product cost. But it's not direct labor because the person is not actually building anything. He or she is just moving things around, right? Forklift. So that's going to be manufacturing over. If you had trouble with these, make sure you continue to practice them. Do as many as you can to practice them in the chapter. To finish up this lecture, let's look at a few other concepts, right? These are just concepts that we're going to use more later on in the course, but we're going to get an introduction to them now. First of all, we'll look at something called a differential cost. So a differential cost is a cost where you compare two alternatives, right? And you look at the cost difference between the two, right? So that's important. Now, so when you look at differential analysis, that sounds like a big term, but all differential analysis means is that you do an analysis and you compare costs that are different. So costs that are different are relevant costs. Relevant costs differ between alternatives. If they're the same between alternatives, so if you have two choices, we can ship to Houston or we can ship to Los Angeles, it costs the same. Well, that's not going to help a manager make a decision. That's why it's not relevant, because there's nothing different for them to make a decision between the two. So relevant costs differ between the two alternatives. Comparing those costs is called differential analysis or differential costs, right? It's irrelevant if there's no difference between the two. And it's controllable if managers have influence over the cost. we only want to evaluate managers, see if they're doing a good job on things that they have control over. If they don't have control over it, and you say, well, you did a bad job, it doesn't really help anybody because they had no control of it. So, they didn't really do a bad job, right? So that's what we mean by controllable costs, right? Now, there's a couple other terms, right? We have costs that are fixed costs. So we're going to use this a lot later on. It's very useful to know your fixed costs because these costs are the same no matter how many cars you make in your Ford factory or whatever business you have, no matter how much activity, no matter how many products you make, no matter how many people you service, no matter how many items you sell, a fixed cost is the same. So an example of that might be rent. So rent might be a fixed cost because no matter how many junior department blouses you sell, the rent's the same usually, in a lot of cases. Variable costs are going to go up or down depending on how much you make or sell, right? So for example, the more cars you make, the more steel you use. That's a variable cost. The cost is going to increase because the cost of steel increases because you use more of it. So the more cost you make, the more steel you use. That's a variable cost. It varies by volume of cars you make. So the same for anything, you use this for anything. The more people stay at your hotel, the more, let's say, they have a breakfast. So the more breakfasts cost you have. So every person that stays at your hotel gets a free breakfast. That's a variable cost. If nobody stays there, you have no cost for breakfast, right? So make sure you understand the difference between those two. We're going to use them a lot in future lectures in this course.